And 3, 2, 1. Here we are, almost halfway through January.
Halfway through. Yep.
Yes, we're technically is halfway. This will be January 15th.
Yep. So the market hasn't rolled off the cliff yet. Everybody said as soon as January 1st ticks over, it's coming, right?
And the avalanche.
What did I just see before we started recording this podcast on Bloomberg? It's Friday afternoon, and it's sort of been building for the last week or two, but I really noticed it today. People are starting to come out of the woodwork with, hey, it's not looking so bad in Europe. Maybe they're going to avoid recession. Maybe the U.S. is going to avoid recession. Maybe is there a bull starting to run somewhere, And I'm like, these guys want to have it not both ways, every way. Right, I mean, it's kind of unbelievable. They've been talking about how Europe is already in recession for months. Mm-hmm. Now all of a sudden they might avoid the recession that supposedly they were in for the last couple of months.
Yeah. I don't know. Did you get a chance to read that Ray Dalio?
I did.
Yeah.
Yeah.
There was a lot of good little insights in there. I might try to put that up on the Facebook group.
Yeah.
I mean, it's a deep dive and it's long, and so a lot of people don't want to read 15 pages of stuff. But it's a good little insight into what Bridgewater, which is Ray Dalio's hedge fund company or whatever, just a little insight from their perspective. Which I one of the things I liked, I kind of liked. How they pointed out the connection between certain, I think would be more fundamental indicators, right?
Yep.
With the jobs and with wages and like how all of it's connected, and it makes sense. And it's not. I don't think it makes sense to people when you tell them like we need a higher unemployment. And they're like, what are you talking about?
Right.
Like we need a higher unemployment, but to make this work. And they're like, well, so we want people to lose jobs,
right?
Kinda, yeah, and it sucks that that's the case, but yeah. Anyway, so that article kind of really did a deep dive in there.
It's a great article, and it's definitely the consensus opinion, which varies from what I just said that I just heard on Bloomberg. Right. But for the last several months, and to include that article, the consensus opinion is that the Fed says we need to be at a 2% Fed funds rate, 2%
unemployment.
Inflation rate, and we're going to raise rates until we get there. Mm-hmm. And there are a lot of people saying, nope, there's no way, we're never getting to 2%. There are other people saying, just look at the data, we're already going in that direction. Mm-hmm. And it's like this, certainly at every bottom. I'm not saying that we're at the bottom, but there's always conflicting data because that's how it churns. It's like...
Yeah, it by default, it'd have to be kind of this push and pull angst going on, or we wouldn't be where we are.
Right.
Yeah, and you never know, like when it's getting ready to turn.
Right. That's how people talk about Elliott waves, right? Mm. You go up in 5 waves, you go down in 3, up in 5, down in 3, until you get a lower high. Then you're going down in 5, up in 3. So it's up, down, up, right, and then it's down, up, and it's the same thing if you're looking at a tide on the ocean, right? If you're looking at low tide, unless you're looking at the tide tables, you don't know.
Is it coming in or going out?
Right. You're looking at it, and it comes in. This wave is a little bit higher than the last one. The next one's a little bit lower than the previous. It's churning. And then at some point, you get a wave higher than the previous. Then the next one's higher than the previous. And you say, okay, yeah. So the trend has changed.
Right. Yeah.
Right. Until it changes, if you're looking at it, you don't know. It's the same thing, and it's really, I think, fascinating.
Well, what do you got for us this week?
So something, I guess, kind of similar we'll start off with the Santa Claus rally is kind of come and gone. And believe it or not, we we were positive, which means we had Santa Claus rally, right?
Technically it happened.
Technically it did. And then after that, we said there's the January trifecta. The Santa Claus rally is the first part. First 5 trading days of January is the second part. And then the closing price of the month of January is the third part. And we're gonna go into that first, and then we're going to do multiple time frames of technical analysis. So I got a question in the members-only Facebook group earlier in the week. We had put out an alert. We reallocated a little bit into the I fund and the F fund. And it was from a new subscriber, and he's like, hey, I don't understand. I watched the show, and you guys said that the I fund, all the funds really, absolutely, you should not be in any of the core funds, right? And if you remember last weekend, the show was mostly, that piece of it was about the monthly charts, right? So for our subscribers, we make reallocation decisions on a daily basis, not on a monthly chart.
Yeah, definitely weekly and daily.
Yeah,
right? Not monthly. Right.
No, not monthly. So basically, what I decided to do was kind of do an explanation of at least how I whittled down from a big view to a medium-sized view to a smaller view to ultimately make reallocation decisions.
Yeah. And also, again, full transparency, we normally record this show late afternoon on Fridays, right? I mean, nobody wants to be in the office till, 8 o'clock at night after the market and everything. So, when things have calmed down enough where we feel like we can do it, we go ahead and wrap up the week, on Friday. Now, with that said, because we used to talk about this like early in the early days, like Jerry even got a T-shirt. Yeah. Saturdays are for the charts.
Yeah.
Anybody that I know that does this, quote unquote, for a living, that is exactly how it is. Why? Because Saturday is the time when, okay, everything's closed. I've got time to go back and look. And this is what Jerry's talking about, starts with the dailies, comes to weekly, monthly, maybe even bigger, and goes back down. And then you start to get a picture of where we're at. Sometimes we're lucky enough that we get enough data points over the weekend to make a reallocation decision before Monday opens.
Yep.
It's rare, but it does happen. And it didn't happen Friday night because we hadn't had a chance to look at it. So you kind of need to time over the weekend, which, unfortunately Jerry gets to work every weekend. But that's when he kind of dissects all of this. And that's what not just Jerry, everybody that does
that's
this.
what everybody does, yeah.
Because the market's closed.
Yep.
So you have time to do the research, time to do the analysis. And then sometimes we're lucky enough, like, nope, all the data points are there. The decision point's there. So why wait till Monday or Tuesday if we know we're going to do it either way? And so sometimes we get lucky enough to put it out early. Not early, but put it out over the weekend.
Yeah, that is helpful for me, for sure, when that happens.
Everybody appreciates it.
So we're going to take a look at that. And then bonus chart, I haven't done in a while, but this one is a pretty good one. Tesla, I bought some Tesla last week or the week before, and I'm going to kind of show you guys why. And then we'll take a look at the TSP funds like we always do. Okay. So we talked about this January barometer we've been talking about it for the last couple of weeks. So I didn't test this. Hopefully it works. Excellent. Santa Claus rally. We had a 0.8% move in the last 5 trading days of December plus the first 2 trading days of January. That is the Santa Claus rally period, and we got 0.8% on the S&P 500. So that is the first of 3 pieces of what's called the January barometer. So we checked that off. After the first 5 trading days of January, we had that time frame was up 1.4%. So that was positive. So we checked that off. So all we have left is the January closing price. Okay, and then we will have a complete January barometer. And if the January barometer is positive for the year, then the year tends to be positive in a pretty significant way. So this chart you can get at Stock Trader's Almanac. It's a couple $100 a year. It's worth kind of the investment if you're into this kind of stuff. But again, all of this is statistical. They're not looking at the same kind of technical analysis stuff that we use here at Grow My TSP. It's a different kind of methodology, but all these things kind of come into play. So what we're looking at here is the S&P 500, the January indicator trifecta, when all 3 are positive. Okay, so here are all the years where the Santa Claus rally, the first 5 trading days of the month, and it's saying the January barometer, so January was positive. So these are all in the black, right? So when those are all in the black, which happened all these years from 1950 to 2023, here the full year later, so the full year, by the end of that year, almost all the time is positive, and pretty significantly positive on average. On average, it's 17.5% gain for the year. Okay. You got 1, 2, 3 times in that whole period. So here we had 28 up years and 3 down years. So that's pretty statistically significant. Okay. It doesn't mean that this year that's going to happen, but it's pretty statistically significant. You get 2023 down here. We had that 0.8 Santa Claus rally, like we said, 1.4% for the first 5 trading days, and we're waiting to see what happens with the closing price on at the end of January. All right. So if we get a positive closing price in here at the end of January, then we're in this, very high statistical odds that we have a positive year in 2023. So what happens if we don't get a positive January? Okay. This one shows the years where we had a positive Santa Claus rally, a positive first five days of January, but a negative for the month of January. Okay. So even when that happens, you still, for the year, 9 times you're positive and 3 times you're negative. Okay. So you're still statistically significantly more apt to have a positive full year than a negative full year. But again, it's statistics, right? So here we are in 2002, which was in the middle, of the .com crash, and you got a minus 23.4 for the year, even though we had a positive Santa Claus rally and a positive, first 5 trading days, and we didn't have a horrible down month in January that year, but we had a really, really bad year for the year. So it's statistics, and if you looked at it that way, statistically, where we are right now, the odds are very good that we end the year positive. But again, it's not technical analysis, it's statistical analysis. Okay, so we'll definitely do an update. We're not going to look at this again until the end of January, but at the end of January this year, we will fill in this blank, and it'll tell us a little bit more information. Okay. So the technical analysis piece, we're going to look at multiple time frames, some of the indicators that I'm using, and then where the buy triggers are. Okay. Most of the time in the show, we look at the 3-year weekly charts, and we don't really talk about buy indicators because for us, if you're a subscriber, the buy indicators happen on a daily basis, not so much on a weekly basis, because you have to obviously buy and sell, meaning reallocate between the funds on a day. And that's what the members get. And so we back that out a little bit for the show and do it basically on a weekly basis. But we're going to show here exactly kind of how I do it. And so here we go. So here's the S&P 500 going back 30 years. Okay, we're going back to 1993. Each one of these ticks is 1 month of price movement. Okay. So this is about as big a chart as you would reasonably look at. It's a 30-year chart. There's not much value in looking at a bigger chart. This is an entire career. So a couple things to point out. This is a 50-month moving average, right? Because each tick is a month. The moving average is 50 months. So that's the blue line. Okay. If you only looked at your TSP on a monthly basis, when the price is above this blue line, you're in good shape. You're making money in the stock funds, right? When the price is below the blue line, you don't want to be there. You don't want to be in the stock funds, okay? And it's really only happened twice in the last 30 years. So if you're only looking on a monthly basis, you would have been in the stock funds for all these moves, and you would have gotten, all the gains. Now, you also would have taken the entire loss that we've had so far in the 2022 bear market, because we are just now, actually as of October 2022, hit that 50-month moving average line. So the bigger time frame you look at, the more you have to accept losses on a percentage basis. Okay, but which just means you have to keep in mind that you're doing this over a longer time frame. So a couple of other things to point out. We talk about these technical analysis tools all the time. Relative strength indicator and MACD are by far my two favorite indicators. When price is moving higher and the relative strength is moving lower, it's called a divergence. Okay. Almost always, not always, but almost always, if relative strength is decreasing as price is increasing, you are nearing a top. Okay, it's not a timing tool, but it's saying it's a way for us to anticipate that a top is coming. And in this case, it's a monthly basis, so you could be a year out and see relative strength decline, price continue to go up, and you just have to have in the back of your mind, hey, I'm seeing that relative strength is decreasing. I'm not getting out of the stock funds because the price is still going up, but I know I'm getting close to a top. Okay, and then when you get a break in the MACD when it crosses down, then you know it's confirmed. Okay. So you're applying the same kind of tools. It just depends on the time frame. So the question on Facebook was, how can we, on a monthly basis, how can you be bearish on stocks and yet an alert comes out on Monday? It's because the alert is on a daily time frame. We're going to get to that. But on a monthly time frame, we're at a pretty important level right now. I think we talked about this last week. The October low hit that 50-month moving average, like right on it, right to the tick. So as long as we stay above that, 3,500 level, this overall bull market is still in place on a monthly basis. Okay, so there you go. If we bring it down to weekly, okay, so we're still looking at a 50 moving average, but now we're looking at weeks. So each tick here is a week instead of a month. And we're looking at 10 years instead of 30 years. Okay, so we're back here at 2013. The vast majority of the time, price is above that blue line, right? So now if you're looking at your TSP only on a weekly basis, the vast majority of the time you're going to be in the stock funds. When it gets below that blue line, you got some pretty significant losses. Okay, you don't want to be in the stock funds on a weekly basis when price is below that 50-week moving average line. Yeah, I'm making this as simplistic as possible. Obviously, this one tool, the 50-week moving average line, we're talking about one tool, that's it. And as you can see, relative strength is decreasing as price is increasing. Right? So you should know that we're not getting ready for a big rally here. We're getting ready for some kind of topping pattern. And we got that, right? We got the little correction there in 15 and 16. And we see it in RSI and MACD. The other side of that is the same kind of thing. The top here in 18, we had a much lower RSI at the end of 18, which was this top, but the price, so price is increasing, the tops are higher, and RSI is decreasing, right? Which is how we ended up with that. So so you're using the same tools. It's just a different time frame. Okay, and obviously these are the big things that we're trying to avoid. But even to get to there, you had to be in the stock funds until, say the end of January, which was a pretty big hit. You're taking this percentage move, whatever it was, from 4750, almost 4800, down to 4250, which was a pretty big percentage gain or percentage loss before you would have gotten out. So a weekly basis is better. You're not taking as big a losses as you would on a monthly basis. But a daily is better than that, although it's more volatile. So let's see. All right, so there we are on a 10-year. So if we zoom that in to a 5-year, okay, so this is the same chart, but it's 5-year weekly instead of 10-year weekly. And we can see price finds support at that 50-week moving average line, right? Price goes up and down, but it finds support until it doesn't. And so if you're looking at a 5-year weekly chart, it gets really, really simple. When price is below that blue line, you don't want to be in the stock funds. But you have to be willing to absorb these losses like this, right? These are the things that people don't want to do, these losses here. I certainly don't want to take them. But if you don't want to get whipsawed in and out of the market, that's kind of what you need to do. You need to set up, in this case, I'm showing 50-week moving averages. If you like 20-week, 25-week, like however you want to set it up, play with it in stock charts and figure out which moving average line works for you and use it. I mean, that's all you do. Okay, so on a weekly basis, again, 50-week moving average line works pretty well. On a daily basis, this is the 50-day moving average line in blue. Okay, so we just went from the 50-week weekly chart to a daily chart. So each tick now here is 1 day of price movement. So now things get a little bit different because price is oscillating along this 50-day moving average line. But if we use the 50-day on a yearly basis like this, we would have gotten out of the stock funds here, which is fine, but we wouldn't have gotten back in until we got above it. And then if we got out when we got below it, we didn't do ourselves any favors. It's basically flat. Now, we're in a bear market overall. We were in 2022, so we would have avoided this loss if we'd have gotten out. But again, we get in here, we get out here. We didn't get any of these gains because we took the gains and we took the losses, and then we get out again, right? So what I'm saying is the 50 period moving average works well for monthly, and it works well for weekly, but it doesn't work so well for daily, okay? So for me, I like to use a 20-day exponential moving average line on a daily chart, okay? It's not exact. We have have to give it a little bit more kind of wiggle room, but for the most part, you get resistance at the 20-day, and you get support. You get resistance. This was an overshoot. You get resistance, support, right? And then when we add in the technical indicators, RSI and MACD, if price is below the 20-day moving average line and RSI is below 50 and MACD has crossed negative, it's a sell signal. And the reverse is true. When price gets above the 20-day moving average line, RSI gets above 50, MACD crosses positive, it's a buy signal. So here's what it looks like on a 1-year chart, right? This is actually 1.3 years, so 2022 starts here. I wanted to be able to show this. So since 2022, right here, 1, 2, 3, 4, 5. It's only happened 5 times. We've had 5 buy triggers on a daily chart, okay? So all I did was line up the price above that 20-day moving average line, RSI above 50, MACD crossing positive, okay? So each of these times, price above the 20-day, RSI above 50, MACD cross positive. Okay, that's all I did. It's only happened 5 times in 2022. Actually, 4 times in 2022. The most recent one happened early this week on Monday. Okay? It's a buy trigger. There are no guarantees that the market's not going to roll over from there. We could get something like this. we had a buy trigger. It consolidated above that 20-day moving average line for a while and then broke down below it. There are no guarantees that a bull market is going to keep going just because that buy trigger hits. But every time that there is going to be a bull market, it will always start when we're above the 20-day moving average line, RSI is above 50, and MACD has crossed positive to the upside. Okay? So these conditions will be there at the beginning of every bull market attempt. But every time these conditions are here does not mean that we're going to get an ongoing bull market. Hopefully that makes sense. So where are we right now? Within the last few days, we had a breakout, a buy trigger. Okay. Here's what the chart looks like. So what I'm saying is, don't, just because we have this buy trigger, don't go run out and buy the stock funds, right? Why wouldn't I? If I have this buy trigger, it's the first one in 2023. We're only 4 of them in 2022. Why wouldn't I run out now and buy into the stock funds? Because if we look at a chart of the C fund, in this case, the blue line is the 200-day moving average. Okay. Every time, well, you can see that there's resistance at the 200-day moving average line during bear markets. Okay. We also connected the tops to draw a downtrend line from the top in January, and then every time we hit this high, we connect the line. We're right on it right now. Today, we're on it. So all I'm saying is, if it was me, and it is, I would wait to see if we can get above that line. Because if we can get above that line, the odds, not the guarantee, but the odds improve dramatically that we can move higher.
Yeah, and this goes back to what we talk about a lot of times with the probability versus possibility, right?
Yep.
Go back one slide. I get us on the right side. So go back that slide. We have just now increased the possibility, right, that we're going to have an uptrend.
Yeah.
Now, again, like Jerry pointed out, the next slide is we're pulling back a little bit, right? So you think of this as zooming in, zooming out. Jerry zoomed out a little bit to go, okay, well, let me see what the other indicators show, right? Let me add some more data to it. Now, if the next step, among many, as Jerry's pointing out, these are the only ones, but if it crosses that trend line, now the probability increased even more.
Right.
That the difference is between your personal risk tolerance.
Right.
That is that when we're always talking about risk tolerance, what are you willing to risk? Now, in my IRA account that I can move in and out anytime I want to, I might treat that a little different, right?
Definitely.
In my TSP, where I only have 2 times in a month I can do it, particularly getting in, right?
Yep.
I'm going to have to get a little bit more data. I'm going to have to get to a little bit more information. Yep. And that's kind of what Jerry's getting to is, when we talk about buy triggers and sell triggers, it really depends on your personal risk tolerance and where you're at in your situation, because you may say to yourself, I'm not willing to take that risk if I'm out of moves, or, you guys get the idea. But so, every time I talk to someone about this and the methodology that we use is it's always like a zoom in, zoom out,
yep.
Right? You start in, you pull out, you go back again. Yep. And then if all of those things that you see give you a buy trigger, then you can feel pretty good. You're going to at least have a higher probability.
Yes, much higher confidence. Right.
Yeah.
Right.
The confidence level is much higher.
The only other thing I'll point out about this chart, which is very bullish, we have a high in January 22. We come down, we put in a low. We recover to a lower high. Then we go down again to a lower low. Now we're in a confirmed downtrend. Okay. We have a little bit higher high here, or a higher low here, which is fine. But then we come up and we can't get above the prior high. And we roll over again. Okay. So essentially we have a high, a lower high, a lower high, a lower high, a lower high, a low, lower low, lower low, lower low, lower low, right? When we have consistent lower lows and lower highs, we're in a downtrend. We're in a channel. what happened at the beginning, end of last year, beginning of this year? We put in a low in October, and now, as of this week, actually, we've confirmed that we have a higher low. Okay, so this is the first time in a year that we have a higher low versus the previous one. So now, if we take out this high here, we can get up here into 4,200. Now we have a higher high and a higher low. So now we have at least a channel in the short term that's moving higher. So it's very bullish. This, I guess it was last Friday, where we got the breakout from this about 2-week-long consolidation. We got that breakout, I think it was last Friday, and it was important, right? It's why the alert came out on Monday. So, again, it's at that point, though, we had not very far to go before we hit the 200-day moving average line and that downtrend line. So, because we have the restrictions in TSP, it's really not worth trying to catch that little bit. You want to wait till it gets above that trend line to kind of validate that it's probably going to keep going higher. Anyway, I think you guys get the idea of it. But at the end of the day, right now, and so a buy trigger doesn't mean that you should go out and buy the stock funds. It just means that the conditions are set so that stocks should continue higher. Then the next step is to look at and see, okay, what's the next resistance levels? One of the things I'm going to talk about in the newsletter this weekend is the significance, particularly of this August high. If we did an Elliott wave count, maybe we'll review that maybe next week on the show. But if we get above this 4,100 level, that's fine. If we get above 4,300, it changes the Elliott wave count. And so I'm going to talk about that on the newsletter because that'll be pretty significant because it'll really change the count for the whole bear market that we've had since the top here. So if you remember, definitely check that out. If not, sign up. Okay. Anyway, that's how we do it. So some of it is very mechanical. Some of it is artistic. What are we talking about? It's like if you go to driver's ed and you read the book and then you have a coach, the guy that's helping you in driver's ed, and you go with the classes or whatever. And
driver's ed teacher.
Driver's ed teacher, yeah. You're in the parking lot, and then you go out on this.
Some coach.
Yeah, it is the kind of coach. Yeah. But you have very limited inputs, right? And you've read the book, and you understand academically kind of how a car works. When you move the wheel this way, the car is going to go to the left, right, like that. But until you are sitting in the seat and you move the wheel and you feel how the car goes, you really don't have any idea what it means in the book when it says turn 90 degrees left. Like, it doesn't mean anything. And I feel like this is what we're doing on the show.
Yeah, we're teaching people how to drive at a basic level.
Yes. So what you need to do is look at the chart yourself and start getting a feel for what they're telling you.
Yeah. I had to do the same thing when I first started, following Jerry's methodology myself. Until I got my hands dirty, until I got in there and started figuring out, what speaks to me and what do I, just getting your hands into it and actually doing it.
Yep.
You don't learn. It's very hard to learn. That's like anything. You have to do practical application.
Yep.
And also, what you guys see here on the show is basically driving at the basic level, right? Driving down the road, turning left, turning right, braking. Yep. What we do, over the weekend is more like Formula One racing.
Right.
Where we've been doing it a while. We've got a lot more skill sets, a lot more is going on, but you got to start somewhere. Yep. And so that's a good analogy for what we're trying to teach here, which is like just the fundamentals of actively managing your retirement account. Yep. As opposed to passively. Like if you go back, if any of you guys have read the ebook, we define that, passive investing versus active investing, right? Yep. And we are clear that we do active, and right. we promote it, and we think it works better. And so you either buy into that philosophy or you don't. If you don't buy into that philosophy, why are you watching?
Right.
Like it's not, we're not going to change our mind,
Right.
And so, but again, it's good perspective to say, yeah, we're not even doing a stick shift.
Right.
We're using an automatic car right now.
Yeah.
Yeah.
I mean, that's kind of the thing. Honestly,
But you can still get there.
Yes, you'll still get
still
there.
Drive the car. You can still get there.
It's interesting though. You can be. People talk about investing as a marathon, not a sprint. And this is how I was driving back from dinner with my college roommate the other night, and I'm on the highway, and I'm thinking through how I'm going to talk about this on the show. And if you're more than the comparison of like a marathon versus a sprint, it's more like driving from DC to San Diego, and the cities that you're going to drive through and the traffic jams and the car accidents and all the things that are going to happen along the way. And how you as a driver can maneuver through that stuff. You can put your car on auto and take what it gives you, or you can actively go around. It's an analogy, so it's probably not great, but the other thing Connor and I were talking about, you can be in a Tesla and you can put all your focus on the car that you drive, or you can put your focus on the traffic and the system basically that's going to get you from DC to San Diego. And so if you're a fundamental kind of person, you would be looking at the Tesla that I'm driving that's going to get me there much faster than the Chevy, whatever. If you're more of a technical analysis kind of person, you're looking at the traffic pattern and the hills along the way, and it's just you're looking at different things.
It's different perspective.
But you're still going to get there.
You don't really care what car you're driving. You're just trying to get there.
Now, if you have no perspective, if you're not pointed in the right direction,
if you don't have a map or compass,
that simple,
you're not making it to San Diego from here.
Right. Probably not.
Yeah, that's the bigger takeaway.
Yeah.
And that's what goes down to, us trying to educate people on how to do this. You can find different ways to do it,
Yep.
or whatever, but if you want to get from here to there, you have to be actively doing it. You can't just be passive or it's not going to happen.
Right. All right, so let's do the bonus chart. Tesla. So we talked about Tesla a while ago. I'm sure I told the story about a guy in my office a couple years ago hits me up and says, "Hey, I made a bunch of money on Tesla. Should I buy it now, or should I sell it, or whatever?" And I want to say, I think he was asking me like, I don't know. I won't be able to show it in this chart anyway, so it doesn't really matter. But I think it was back in 2019. At any rate, the reason I wanted to show this was these are Fibonacci retracement levels. So this low in 2019 is not the all-time low for Tesla at $12. If you pulled back to the all-time low, it's like 25 cents. And it's 25 cents because the stock split several times. So this chart takes into account the splits. So at some point, Tesla was up here, well over $800. Even though in this chart it looks like the high was $520. It's relative to the splits. So if we take this June 2019 low as the low for this example, and we pull the Fibonacci tool up to the high in late 2021. As of a couple of days ago, price came down and hit that 38% retracement level. Okay? This is on a logarithmic scale. Right? It's not a straight price scale, it's logarithmic. So from a percentage basis, which is what the logarithmic scale tells you, on a percentage basis, from the low in 2019 to the high in 2021 to where we bottomed out here early this week, end of last week, it was a 38.2% retracement level, hit right to the tick. So that's significant, right? You should expect some support at those Fibonacci levels, and that's what we got, right? We got price kicked up a little bit over, the last several days. So that's one sort of data point. The next one that I thought was interesting was taking the same chart and doing it on a price basis, not logarithmic. So this is the actual price, okay? So it looks much different. So we're down here at the 2019 low. So we're in the same place that we pulled the Fibonacci tool the last time. And the top here is the same as the last chart. But now price on a nominal basis is down exactly 78.6, right? Which is a different Fibonacci number. But it's right to the tick. So the more things that you can layer on top of each other, the more likely you are to find support and or resistance at those levels. And so when I overlaid both of these charts, I bought Tesla right there at the bottom. And it's at $100. All those round numbers are significant. Things happen at round numbers. Either there's support or resistance, but things, for whatever reason, tend to happen at round numbers. So this one was kind of a no-brainer. When it hit 100, I'm like, nope, I have to buy it. And of course, yes, it went higher, so that's great for me. If it got below 100, I was going to immediately sell it because it didn't find support there. So the risk reward was very, very high. And we'll see what happens as it goes forward. If it gets below 100, I'll sell it. It's not a big deal. If it gets up to that 175 level, which is where it hit right there, I will certainly sell some of it there, right? Because can it come back down and keep doing that? Yeah, absolutely. And this would certainly fit within the channel of it. So that's basically how you do it. Okay. TSP Fund charts. We're back to the 3-year weekly. Every time we get above this, and then we're on a 20-week moving average line. Okay, this isn't the 50. We were talking about a 50-week before. My kind of go-to on a weekly chart, much like I do the 20-day moving average, I do the 20-week moving average if I'm looking at weekly charts, and so that's what we're looking at here. We get above that 20-week moving average line. We get support every time we correct down to it until January, and that was the first big indicator to get out of the stock market, get out of the stock funds. Ever since then, yep, we've gotten above it a couple of times, but it hasn't held, and we're right back to it right now. We're above that 20-week moving average line, and things are different now than they were in 22 because in 22 we kept having lower lows, and now we have a higher low, and we're above that 20-week moving average line. Now, we have this downtrend line, right? So if we can get above that downtrend line and we can get RSI a little bit better than where it is right there, that we've seen this game before, basically. So I'm not there yet to buy it, but that's my personal circumstances and risk tolerance. Everything is lined up. Technically, we're at RSI is at 51.79. It's above 50. MACD has crossed positive. We are above that 20-week moving average line. So technically, there is a buy trigger in place. Now is where you apply your personal circumstances and risk tolerance and any other tools that you want to look at. So I tend to apply a downtrend line, and I say, okay, I'm not ready to buy it yet. But if you want to buy it, have at it. Okay, S-Fund. Same kind of thing. We kind of have a smiley face here, which if JC is listening to the show, he would appreciate that we are kind of mimicking his stuff and saying, hey, what I learned is to buy the smiley faces and sell the frowny faces. So you could argue that this is more of a frowny face that you should sell, and this is more of a smiley face that you should buy. Okay? Again, we're just barely above that 50 line. MACD is not very convincing. Yes, it's going in the right direction. It's just not very convincing. It would, it's close enough. let's say that's the bottom line right there. So we have a triangle. Theoretically, you have a down, a triangle, you should have another down, right? Doesn't mean it has to happen that way, but generally it does. So I wouldn't buy this myself until we get some kind of breakout significantly to the upside. If you want to be very safe, I'm not buying it until we get back above that high. iFund, obviously a completely different animal. We had a massive breakout above that 20-week moving average line there. We got hugely above the 50. MACD exploded higher to the upside. We barely got a pullback, and we didn't pull back to the 20-week. The move is so strong, and then in the last 2 weeks, it just keeps getting stronger. So yes, it would have been great if you were looking at this and you got into the iFund at some point back here. But this is a very bullish chart. And so, the problem, of course, now buying it at this level is that the risk is that you have to let it come all the way back down to the moving average line and absorb these losses before you make a decision to sell it if it gets below that level, right? But iFund's in a bull rally, no doubt about it. I mean, if everything keeps going, iFund keeps going. F-Fund, same kind of way, right? Big move above that 20-week moving average line right there. Came down, tested it, got a little bit below it right there for 1 week. And for the past 2 weeks, we're exploding higher. RSI looks very strong. MACD, very strong. F-Fund looks good. So hopefully this gives you guys an idea of what we're looking at. And again, these are weekly charts that we do on the show. And we whittle it down to a daily basis so that when we put out the alerts, people understand why we do it on the day that we did. Okay.
Questions.
Yeah.
As always, if you have questions, you can put them in the comment section wherever you found the video. If there's no comment section wherever you found the video, then you can shoot us an email, support@growmytsp.com. And I just need a recording of this where I push
that's what it sounds like. Yeah.
I do that on purpose because I want it to be like don't take this while you're
driving machinery.
Whatever. But yeah, we have to say it after every time just because, people
might not know.
New people watching the show. We're happy to have your questions, and we love – a lot of times what we get from the questions are topics for another show, which is great.
That was this week, basically. Yeah.
Absolutely. Well, we hope you guys are having had a great weekend, and hope you have a great week coming up, and we shall see you
next week.
Cue music.